Good afternoon, everyone. I am Alice Shen. I am a portfolio manager from VanEck, Australia. And today I'm really glad to be invited by Tiger Brokers to give you a presentation on the recent gold rally. And so far, we have seen a very, very strong gold rally coming into the end of 2025 almost. And investors are wondering, where do we go from now? Hopefully today, the presentation will give you a clear picture of what's currently driving the gold price and the fundamentals and technical factors that's going to support the gold price going forward, and the catalysts to watch out for by the end of the year and going into 2026. And just a quick disclaimer here that today's presentation is general advice only. We encourage you to go to our website, vaneck.com.au, for PDS and the TMD for more fund-related information. Before I dive into the nitty-gritty of gold and the gold rally recently, I thought it's quite beneficial for me to introduce VanEck as a fund manager. We launched or set up our business back in the 1950s, and now we have multiple offices around the world, specializing in both mutual funds as well as ETFs. And for gold specifically, we are the gold people because we actually launched, we've been involved in the gold markets for over 55 years, and we are currently still managing one of the oldest active gold strategies in the world. And then we sort of pivoted and pioneered into the gold mining exchange traded funds, or the ETFs, back in the 2000s in the US. And this has really given VanEck an edge in the gold mining space in terms of the gold assets we manage as a whole globally. Back in 2006, GDX, the first gold miners ETF, was launched in the US, and currently we have $23 billion assets under management. And 2 years later, back in 2008, we also launched the Junior Gold Miners ETF in the US as well. And then fast forward to 2013, VanEck Australia was set up. And 2 years later, we brought GDX to Australia, which is now listed on ASX as well. And the fund has 1.4 billion AUM as at the 6th of October. So broadly speaking, overall, VanEck has around 259 billion assets under management as a whole business. And for VanEck Australia, we currently have around 27 billion Australian dollars listed on the ASX. And just to give a bit of context for how big the GDX, the VanEck Gold Miners ETF is, just one day, it trades at around 1.6 billion Australian dollars equivalent on the exchange in the US. That's around 20% of the total daily turnover for ASX. So that is quite substantial. And we are really glad that Australia now have this exposure as well for investors who is interested in gold as well as gold miners investing. Now, with the rich history of VanEck investing in gold and gold mining, we've actually become quite major shareholders in a lot of the Australian as well as international gold mining companies. As the slide shows here, that we are actually #1 shareholder in companies like Perseus Mining, Capricorn Metals, as well as resources. And this applies to international gold miners as well. As you can see, we are top 5 shareholders in quite a lot of big names in the gold mining space. Now, back to the very hot topic at the moment, which is gold. It has been making headlines, and it is in investors' front and center. So just with all these headlines pumping into investors, and despite the recent stellar performance of gold and gold miners, it's actually still underrepresented in a lot of investors' portfolios. And we like to encourage all of you today to really have a look into what's happening in this space, and hopefully the session in the next 15 minutes or so can bring you some more insights into why gold is rallying at the moment and why it could have potential upsides to come. And also, I think it's really important to remind ourselves that gold is special in that it has been used as a form of money for thousands of years. It's used as a unit of account. It's used as a store of value. It's used as medium of exchange in the past, up until in the 1970s when the Bretton Woods system collapsed. Back then, the US dollar was still pegged to gold, and since then it has delineated themselves. But gold still holds a very special place because it does have an intrinsic value, and central banks around the world still hold it as important reserve asset. It is a natural resource that's limited in terms of quantity. It doesn't carry any liabilities risk or any counterparty risks. And as a result, when confidence in the market starts to deteriorate, investors usually go to gold for a safe haven asset. And now, in terms of the drivers of the gold prices recently, we think there are key major factors. The first of all is the weakness of the US dollar at the moment. As we all know, a lot of the commodities, with gold included, they are priced in US dollars. So if there is a weakness in US dollar, that will usually create momentum for gold prices and vice versa. And second factor that drives gold prices, just like any other commodities as well, it's dictated by supply and demand dynamics. From the demand side, there are several sources, one of which is the central banks, which have been the strongest driving force for the gold rally in recent years. And then secondly, investors, institutional investors mainly, we have seen actually an emerging trend that the Western investors previously have been relatively muted, but now they are actually coming in to the gold market for gold purchases and ETF purchases as well, which I will touch a little bit more later. And the third factor from the demand side is manufacturers. There are usage in manufacturing, especially in some of the medical devices and also jewelry companies. They also use gold for their raw input for manufacturing. And in terms of the supply side, cost of production to dig gold out of the ground is obviously an important one. And the other two factors include mining flows as well as geopolitical risks as well. And last but not least, there are market conditions in the financial system, which is more nuanced, and it does impact gold price very tremendously as well. You know, at the moment, we have a lot of volatilities coming through from the tariffs, from geopolitical risks, and also probably some people would argue a lack of confidence towards government to manage their piling debt or the monetary policy, whether it's effective to curb inflation as well. So these three key drivers are what we think going to dictate how gold price is going to go in the next 12 to 18 months. And here in this slide, I have the chart of gold price as well as the GDX index, which is the 90 ARCA Gold Miners Index. And I put them together from 2021. As you can see, gold prices really sort of took off from last year, and this year it has been a tremendous year so far. We are looking at the gold price. If we just look at the past few months, I think from mid-April to mid-August, it was range trading at around 3,300 US dollars per ounce, and then last month it actually was kicked into a higher gear with even more relentless price increases, breaking records almost every single week, which is quite incredible. And for gold miners in particular, we are actually seeing the leverage coming through. That means that when gold is in a bull market, gold miners tend to outperform the gold itself, and vice versa. When it's in the bear market for gold, gold miners tend to underperform. So there is a leveraged effect for gold miners in these two scenarios. And people are always asking us now, given this fierce rally, is there more to come? And we do think that there is more gas left in the tank because, you know, as I mentioned earlier, a lot of the investors are worried about the government's indebtedness, and also the demand for gold is very, very supportive for gold to push up higher. And we think this winning streak is going to continue from here. This bar chart here is a performance summary for all the major asset classes around the world. This is year to the end of September. And since then, gold and gold miners have rallied even more. I haven't even got a chance to update because the price movement is just so rapid, and it's really pleasantly surprising to us as well. But we do see that there could be some more upside to come. And here, in this slide, I have a chart. It can be a little bit busy, but let me explain to you this. So the navy colored line is showing the ratio between the gold miners to gold dated from 2005. So we have 2 decades of data. And then I also overlaid it with the gold price in the turquoise color. And also the ratio currently is in purple. And then the long-term average of gold miners to gold is shown in orange. So as you can see, there's still a gap between where we are now for gold miners to the long-term average. And if you ask me what's the more bang for your buck at the moment, I would say gold miners, because there's still a gap to be closed. And at the moment, gold miners is still undervalued compared to long-term averages. Now, let's turn to the demand side. I mentioned that central banks have been a very strong driving force for the demand this year. And it actually even goes further back. Since 2022, actually, central banks have been holding gold in a pretty amazing speed because they appear to be less sensitive towards interest rate changes and less sensitive towards the macroeconomic environment. The official data from the World Gold Council actually suggests to us that the rally or the surge in demand has been pretty consistent, and central banks are continuing to buy gold. And just from the survey that was done by the World Gold Council this year, respondents overwhelmingly suggest that central banks will continue to increase gold exposure in their gold assets for the next 12 months. So that's one of the reasons that we believe this trend is going to continue. Central banks will continue to increase their gold exposure. In the latest data we have seen so far, as at the end of August, we have seen central banks around the world adding a net total of 15 tons to the global reserves. In terms of the country breakdowns, Kazakhstan actually led the buying for the month, and also Poland, which has been the strongest buyer so far this year, also reaffirmed their stance in terms of their gold exposure to increase their target from 20% to 30%, well above its peers. And also China, it has also reported 10th continuous increases by month. And now their reserve is sitting at over 2,300 tons. Despite the recent moderation of central bank purchases from some of the data sets we've been looking at, we do think that the demand will be resilient and will be robust, which will going to be a very important driver for the gold's upside going forward. And the second source of demand for gold is investors, and this can be really measured by the gold ETF flows. So global physically backed gold ETFs have actually seen the largest monthly inflow in September, totaling at around 26 billion US dollars, making Q3 the strongest quarter on record actually. So who are the buyers? Previously, North America have been quite muted, I would say, since 2022, but now they are coming very, very fiercely, with North America in September scoring around 10.6 billion US dollars inflows in September, the fourth consecutive monthly increase. And then the second place goes to Europe with 4.4 billion US dollars inflow in September. This is their third strongest month so far. Their gold purchase is probably influenced by the stagflation as well as inflation concerns in the ECB and in the UK. And last but not least, the third place is from Asia. Their contribution to the gold purchase in ETFs have been at around 2.9 $1 billion for the month of September. Countries like India, like China, and Japan contributed to this ETF buys. Culturally, for India and China, they do tend to buy gold as a safe haven or a store of value, or even with important holidays, they would tend to buy quite a bit of gold for, even celebration. So there is a cultural element to that for demand from both India and China, and this has been quite stable, and a cultural element plays in it for the demand. And now we just touched on the return of Western investors, and a large chunk is coming from the US. So what's happening in the US? Well, we think that this is the holding of gold from the US investors' perspective is primarily driven by the uncertainty of geopolitical risks and also dollar weakness, as well as the Fed cuts in September the 17th, and the market is expecting 2 more cuts by the end of the year. And we think on top of these reasons, another more important reason is that the fiscal debt in the US is piling up, is creeping up quite significantly, actually. If you look at the chart on the left-hand side here, we are looking at the federal debt accounting for over 120% of GDP already. Just the interest payment alone to service this kind of level of debt already surpassed the spending on defense last year in the US. So that's quite significant. Investors do have reasons to be wary that US assets might be less creditworthy now, and they are turning to gold for capital reservation and protection. And when the US runs persistent budget deficit, as you can see on the right-hand side here, it usually issues more treasury bonds. So there are more bonds and more printed money essentially in circulation in the economy, and that would create more inflation problems. As many of you would have seen that the US inflation, which we look at on a monthly basis, if we look at the headline as well as core CPI figures, they suggest that the inflation is still there and it's quite sticky. And gold in this case has been a great tool for inflation hedge. And in this slide, I'd like to also explain to you the inverse relationship of gold prices compared to the real 10-year bond yields in the US, as well as the inverse relationship between gold price and the US dollar index. So let's start from the left with the inverse relationship between gold and also the 10-year real yields. This can be explained by the fact that gold is a non-yielding asset. Sorry, I think my light just turned off. Sorry, bear with me. Let me turn the light on. Here we go. Apologies. So gold is a non-yielding asset, meaning that it doesn't pay any dividends or any interest. And for bonds, on the other hand, they do pay coupons on a periodic basis. So if the rates are going up, if the yield is going up, then investors would obviously switch to a higher yielding instrument like bonds. And then as a result, the gold price would drop because the demand would drop. And on the other hand, if the bond yields decrease or even to the negative value, investors will tend to flock to gold for more capital preservation. So that's why there's an inverse relationship between gold prices and the US 10-year yields. Essentially, the real yields reflect the true cost of holding gold. But then, since 2022, this inverse relationship kind of broke down because that's when the US Fed started hiking rates. And then, as you can see on the chart here, we do have a very steep increase of the real yields at the time. But then you would also see that the gold price actually went up together with the real yield increase. So why is that? Because that's because when the Fed started hiking rates, investors or the markets were really concerned that the Fed, they really doubted that the Fed would manage the inflation creeping up. And also we had the war with Russia and the Ukraine at the time. So this kind of double whammy created an interesting dynamic where 10-year yields is going up and gold prices going up as well. But now we are seeing that the real yields kind of normalized at around 2% level. But then gold prices continue to surge. So going forward, we don't think the 10-year yields is going to dictate where gold is going to go for now. Rather, the demand side, as I mentioned earlier, the central banks buying, the investors buying will drive the gold price to a larger extent, at least in the next 12 to 18 months. And then if we move on to the right-hand side here, I have the chart of the gold price and also the US dollar index. The US dollar index is essentially a measure of the US dollar strength against a basket of developed market currencies. Historically, they have an inverse relationship as well. If you think about the gold prices, they are denominated in the US dollar, as I mentioned earlier. So if the US dollar strengthens, foreign investors would need to spend more to purchase the same ounce of gold, and that would lead to a drop in demand, then the price will fall, and vice versa. So this inverse relationship has been there as well. But we also know that for gold and US dollars, historically, they have been both safe haven assets. But if there are any sort of extreme market volatilities going on, investors will always go for gold. We've talked a lot about gold so far in this presentation, and for us, we look at gold miners as well, and gold miners are actually showing very promising aspect in terms of their expanding margin with this current bull market in gold. If I can draw your attention to the table here in the second column, we have the average gold price. As you can see, for the past 10 calendar years, it was at around $1,600, and then recently it has been really surging, and it's quite incredible to see. But then on the other hand, on the first column, you would also have the all-in sustaining cost for gold. This is how much it costs to mine gold. Obviously, we have endured quite high inflation environment in the past few years. These gold miner companies were obviously not immune to that. Costs have increased, but the rate of increase is nowhere near the increase of gold recently, and that creates a very constructive or healthy environment for gold miners to really expand their profit margin, and a lot of the disciplined mining companies can now generate quite robust cash flows and benefiting investors from the dividend payout. And another question that we get, apologies if I didn't mention earlier, feel free to leave any comments in the comments section, and we'll be able to answer your question at the end of the presentation. Apologies, I should have mentioned earlier, but feel free to leave your questions that we are more than happy to answer at the end of the presentation. So back to the presentation, we often get asked a lot as well that should we buy gold now or should we buy gold miners? This is one of the most popular questions we get asked. Well, we do think they both have their merits. Obviously, the risk return profile is very different. Gold bullion or gold itself is very conservative and usually low risk, lower return. But it is a typical safe haven asset. Whereas gold miners, on the other hand, as I mentioned, there's a leveraged effect. When the gold market is running very hard, gold miners usually even run harder, and vice versa. So we do think that a combination of the two, even 50-50 portfolio, would protect you from downside and also allow you to capture the upside in the bull market. In this slide, I have correlation matrix of gold bullion as well as gold miners compared to all the major asset classes around the world. So we have Australian equities, international equities, emerging market equities, A-REITs, Aussie bonds, and global bonds. So as you can see, at the bottom two rows here, we have the correlation, and they do appear relatively lower. So they are less, both gold and gold miners are less correlated with a lot of the major asset classes from the data we have seen over the long term. And from VanEck's perspective, we offer investors two choices to gain exposure to gold. The first one is purchasing gold bullion via an ETF. Just note that this ETF is backed by physical gold, and the gold bars itself is actually held in a vault by our custodian, Perth Mint. And the second way to gain exposures to gold is through investing in gold mining companies using an ETF. This will be a basket of global miners globally, and there is a potential for dividend income as well, which is not the case for investing in gold bars itself. Now, let me quickly give you a breakdown of our offerings. The first one being the VanEck Gold Bullion ETF with the ASX ticker NUGG NUG. It has the lowest management fees among all the gold ETFs listed on ASX, with a management fee of 25 basis points per year. And what's special about the NUG is that the gold, which is held in this ETF, is only sourced from Australian gold producers whose operations adheres to the LBMA Responsible Gold guidance, And also, investors are able to convert their ETF holdings into physical gold at the Perth Mint. And VanEck can definitely facilitate this conversion if needed. We think this is a relatively safe play if you do want to gain exposure, if you haven't already, for gold. And the next is our gold miners ETF with the ticker GDX. It was launched back in 2015, and currently the AUM is at around 1.4 billion Australian dollars. The GDX index is quite unique in that it is a pure play. It requires the constituents to at least 50% of their revenue from gold mining activities. And GDX is also a more cost-effective option with a relatively low management fee of 53 basis points per year. Just with one trade on the ASX, GDX allows you to have an instant access to more than 80 companies with the largest market cap and the best liquidity in a gold mining space. Now, in terms of our outlook to gold and gold equities, I think I've expressed earlier as well. We are constructive in terms of the gold and gold mining stocks. Here's some of the reasons why. First of all, we think geopolitics and sentiments will drive how gold will going to go in the next few months. The geopolitics is really playing out and it changes day by day. There are many, many moving parts in the economy. If we look at just the US and China trade tension, it was fine for an extended period of time, and now it flared up again just this week. So we're looking at export controls again and additional tariffs from US to Chinese goods with an additional 100%. So that's going to be quite significant. But the negotiation is still ongoing, and the two leaders are still going to scheduled to meet in the APEC meeting at the end of the month. So obviously, this sort of tools will allow them to have potentially more leverage. But then we do think they are going to achieve another deal by the end of the month. But this sort of unexpected activities definitely creates more volatility in the market and will drive investors to gold. And if we look at France as well, a bit of turmoil happening in their political space. The French PM had snap resignation and then got reappointed again just a few days later. And the new cabinet actually retained most ministers, but then the opposition parties have filed motions for no confidence. So we're just gonna see how it plays out. But if there are any unexpected outcomes coming from there, that would increase the volatility in the market as well. Japan. Historically, Japanese yen has been a safe asset, just like gold. But now there is some political movement as well. The candidate Sanai Takaichi, sorry if I butchered her name, she is poised to become Japan's first female prime minister. But then the clock is also ticking. That because she will need to get a confirmation vote. If she were to be elected, that's going to change the dynamics in the Japanese market locally, but also the relationship between Japan, US, and China as well. And also in this chart, at the bottom, I have the market sentiment indicator towards gold as well. So the United States CFTC gold net positions is an indicator for analysts and traders around the world to gauge the bullish or the bearish sentiment for the market of gold. As you can see here, the net position has remained above zero for an extended period of time now, and we don't think this is going to change anytime soon. The overall market is still feeling bullish towards gold. I previously touched the gold ETF flows over the years, and now this chart I think is also pretty telling in terms of how gold is going to go in the next few months at least. So if I can draw your attention to the red box here, that was from back in 2020. From March to October, the ETF gold bullion holdings actually shot up quite significantly from around 88 million ounces to 111 million ounces in just a short period of a few months. And that coincided with the gold price surge of around 600 US dollars per ounce at that time. Currently, the ETF gold holdings is nowhere near that peak yet. We are currently looking at only 97 million ounces. But if we do the math and do the extrapolation, we would be looking at an additional $400 per ounce increase for gold. Clearly a reason to be very constructive of the gold price, because the reasons that I mentioned earlier, the return of Western investors, especially the investors in the US, and also consistent central bank buying gold as their reserve assets. And this slide is less of an outlook, but it is a note that we would like to highlight to our investors. As I mentioned earlier, US gold is priced in US dollars. And for Aussie investors, how do we go about the currency exposure when it comes to US dollars and Aussie dollars? We are seeing that there are a few products in the market now where gold is hedged back to AUD. But then this actually doesn't make sense to us because we have done an analysis in this slide here. So from the left-hand side, we have a scatter plot of the gold prices and again against the USD AUD movement. You can see that it is pretty messy. The dots are around all four quadrants of this chart. So we actually can't see any patterns derived from AUD USD movement with the gold price. So, and we did some statistical analysis to measure how correlated these two factors are. And in statistics, a specific measure used to measure how correlated the two variables are is by R squared. And R squared is a measure between 0 to 100%. The more correlated it is between two variables, the higher it gets. So 1 or 100% is identical, essentially, or most correlated. And in this case, as you can see, the correlation or the R squared is only 13%. There's no evidence to suggest that these two variables correlate at all. And then if we break it down by decade, on the right-hand side, different colors but still no patterns to indicate that AUD USD against gold price has any sort of patterns. So from our perspective, our conclusion is that there is no reason why you need to hedge your gold exposure back to AUD. And last but not least, I'll leave you with a few more catalysts to look out for in the markets that could potentially move up dial for gold prices. First of all is a data point a lot of people are watching is the Fed's rate decision at the end of the month and also the 10th of December. Currently, the market is pricing two more cuts on top of the 25 basis point cuts back in September. So, and also locally in Australia, we also have two more RBA meetings where the rates will be decided from there. And locally, the market is not expecting any cuts by the end of the year. So any sort of anomalies or unexpected activities coming out of these meetings will definitely give market a bit of jitter and potentially positive for gold. And also in the US, I mentioned earlier that the fiscal debt piling up is an issue for the US economy, and potentially there are some cracks coming through. So the next activity we are closely monitoring is also the Congressional Budget Office forecast, the CBO forecast, that's scheduled next month for their long-term budget outlook, in which long-term projections of the US budget and economy will be presented. And we are keeping a very close eye on it. And then more broadly, the US government shutdown is still ongoing. We don't know how long it's going to take to recover. So a lot of the key data points are actually going to be delayed, or even accuracy could be jeopardized. So like the employment data that's scheduled by the end of this month, and also the CPI figures, which is scheduled. Apologies, the employment data is actually due today, and the CPI number is at the end of the month. So we'll also be looking at that. But our overall stance is that the market is going to be volatile by the end of the year, and that bodes well for gold and gold prices. So here's a little summary of what we have gone through in this presentation. We think that gold is one of the most traded asset classes in the world, and investors usually turn to this sort of gold haven assets when there is market uncertainty or turmoil. And VanEck offers two ways for investors to gain exposure to gold. One is a gold bullion ETF, a NUGG NUC, and the other one is the gold miners ETF with a ticker GDX. The current macroeconomic context, in our view, is very supportive of gold prices, and we do think that there is still further room to run for gold to achieve a higher price point. And also gold miners, a leverage play of gold in the bull market, usually it outperforms. So we do encourage investors to have a look and understand a bit more about gold miners in general. Thank you all for your time. I know it's quite jam-packed, and I do hope you find this session useful. Any questions, I'm happy to take now. Thank you very much again for your time. And I will just quickly check the questions coming through now. Okay, I have a few questions now. Um, the first one I have is that how much of gold's current performance is driven by investor sentiment versus fundamental supply and demand? Um, yep. So I covered the supply and demand. Let me quickly return to that slide. A few drivers, one being supply and demand. We think for this current bull market, it's mainly the demand coming from the West and also central banks that's pushing up the gold prices. Sentiment, we do know that it has been bullish. I actually saw because I'm based in Sydney the other day, there has been a very large queue in front of a gold bullion shop. So people are actually jumping on the bandwagon as well. So the sentiment is definitely high and positive towards gold, but we do think this time around it is still driven by the strong demand from the Western investors and central banks. I should add that, um, sorry, just the second question is that are there any emerging catalysts or technical signals that could change gold's trajectory? Well, we obviously are monitoring the sentiment through the futures position in CFTC by the US. So any sort of downward trajectory that we're going to see there when the positions are turning negative, for instance, that potentially indicates that the sentiment for gold is becoming less bullish. But that's one of the indicators that I will be looking at. The next question I have is how can investors evaluate the value and the risk in gold mining equities compared to physical gold? In general, gold mining equities are more risky and potentially more reward compared to gold itself. It is a leveraged play because, as you can see in the table for margins of these companies, when gold prices increase, all things being equal, we can ignore the cost of inflation or cost of production for now. They can actually add their own margin to on top of the increasing price. Hence, this gold mining sector is leveraged up when it comes to bull market in gold, whereas on the other hand, if gold price drops, then the gold miners usually do worse. So there is higher risk, higher reward factor in gold mining stocks compared to gold. Um, I have a prediction question about, do you think predictions of gold surpassing 5,000 USD are realistic in the near term? Um, from the calculations we did, we are relatively conservative, but we do think there are potential upside to go. Just looking at the gold ETF holdings in this slide. If we look at the history back into 2020, when ETF holdings in gold shot up quite significantly, the price action has been very strong as well. If we just do the math, I would say around 4,400 is definitely achievable, but 5,000 I don't have the analysis to it, but it could also be in the headlines. Sometimes you grab someone's attention, so that could be a factor as well. But we do think there is potential upside to it. But it is a crystal ball question. No one would actually know until we are there. So what I can say is that we are constructive in gold prices, and we do think there's more gas left in the tank. Okay, I think we have 3 more minutes to go, and I have a few more questions. Could new demand from investors or funds push gold higher? Definitely. This bull market, central bank buying, and the return of Western investors have been the driving force, the major force of the gold price surging. And we definitely think that there could be more demand coming through. Wondering if VanEck has plans to launch a physical gold ETF too. Sorry if I didn't explain clearly, but we do have the physically gold-backed ETF, NUGG, NUC. That's already been listed with the inception 2022. So investors can access this physically backed gold ETF via ASEX through an ETF trade. And the last question I have is that do you think gold price can drop back to around 3,500 US dollars in the next 6 months? So I do think that a bit of normalization or range trade is possible in the next 6 months, but I don't think it's unlikely it will go back to the level of 3,500 just because the market volatility is still there and the demand has been quite resilient. And I don't think it's going to go away anytime soon. So we do think that it is unlikely to drop to such a low level back to 3,500. Okay. I think that's it for the questions, and we are right on time. I would like to take this opportunity to thank you all to have joined this session with me, and hopefully you find this insightful. And I encourage you to continue being with Tiger Brokers platform, and also there are quite a lot of gold ETF opportunities for you to explore. Thank you very much for your time. Have a good day ahead. Bye-bye.